is the market itself headed? Do we get the 7,800 shortly? And are those targets of 8,000 and 8,500 that so many people told us after the elections still valid? Manish Gunwani, the Senior Fund Manager at ICICI Prudential, joins us. Good morning, Manish. Thank you very much for dropping in at our studio. That's really the first question. Today we had Jonathan Garner of Morgan Stanley telling us that the budget did not quite live up to the wild expectations, and he's actually preferring China over India at this point in time. Okay, that's one call. But do you think that those 8,000 and even 8,500 calls we got still valid for 2015?
Well, we can't put targets, but from our perspective, the budget was extremely realistic and pragmatic. I think the focus needs to be to make it easy to do business in India. And there were a lot of details in the budget, whether it is visa on arrival, REITs, etc., which essentially the philosophy seems to be to make it easy to do business. And I think that is what we need at this point of time. So from our perspective, it was a good budget.
Okay, no, but what about the gains from the index itself, say 12 months down the line? What would look realistic for you?
I think we will get pretty healthy gains. So if you look at what we've been saying, that while valuation obviously is a bit higher versus 6 months back, but the improvement in macro more than makes up for that. Okay. So on a 10-year basis, for example, the price to book is at median level. And you are sitting at a point where there can be reasonably significant earnings acceleration from here. Okay. So if you put that in context, I think equities is a good place to be right now.
Okay. That's actually what the consensus view is on the street about equities being a good place for the next couple of years. But I wanted to ask you about how you marry the global cues in all of this, because suddenly we've seen risk appetite emerge back across the globe. Is that one of the key reasons why our market is also moving up higher? And do you think this healthy global market phase will last?
Definitely. I mean, if FIs are such a big part of our market, then global cues definitely matter. And if you see, the capital markets globally are very benign at this point of time. The risk parameters are pretty low. So obviously it will matter. It's a different thing that's always difficult to predict where they're going, because when they change without any leading indicators. They just seem to happen at any point of time. But yeah, it is important. But I think you have to look across time frame a bit, because as I said, if we see a bull market in Indian economy, then invariably we'll see a bull market in the Indian stock market. So if you see the raft of economic data coming across over the last couple of months, whether you take IIP, export growth, PMI, car sales, two-wheeler sales, kind of it seems to be pointing that things are turning positive. And if the Indian economy does well, there's no reason why the stock market will not do well.
No, Manish, no taking away from the fact that the macroeconomic balance is getting restored.
Right.
For the first time in the past 7 days, we have got a data where growth is up and inflation is down.
Right.
Even though inflation rates are still higher than growth rates. But how much do you expect that will give to earnings or earnings upgrades this year itself? What are you working with in terms of an earnings growth for FY15? And what are you expecting for FY16?
So FY15 may not be the star.
But how much? Is it
maybe
10s, 14s, 20s?
Around 10%. But just to get a longer time frame, the 20-year growth in Sensex EPS is about 15%. And last 6 years we've been at a CAGR of 8%. So if the economy revives, there is no reason to believe we will not go above trend. So it may not happen in 15. But definitely 16 and 17 can be pretty strong for earnings.
Okay. So when you say pretty strong, you mean 20?
I guess if the trend is 15, you're obviously looking at a number above that. It could be 18, 20, 25. It's difficult to model. But definitely looks like a healthy number.
So then what is the 12-month target for the Nifty or the FY16 average?
Well, we really don't give out any Nifty targets. But if you look at it from an Indian household perspective, we still think equities is the best asset class, because like we did some estimates, almost 70% of household net worth is still in gold and real estate, and only 2.53% is in equities. And you're getting a market where the earnings acceleration will happen in 16 and 17 at a price to book which is median for last 10 years. So net we still think equity is the best asset class.
Okay, so if we do see, the household savings get channelized into the equities in the times to come, which are the primary beneficiaries in terms of sectors where you see the allocation improve?
So obviously, if the economy revives, the domestic cyclicals, the earnings will inflect there more than other sectors. So I would guess all your domestic cyclicals from capital goods, banks, infrastructure, autos, energy, those would be the sectors which would benefit more.
Well, actually, our money control borders can also ask you questions, and one of the questions is actually dovetailing what Sonia asked you. The question posted on the message board is from Shantanu Prakash, and he is asking which banks would be the biggest beneficiaries of the new infra lending norms? Even sector-wise, would it be private, public? And is it banks or is it infra that we should look at?
So we are not asking you stock-specific
Right.
questions. He's asking you that question.
So obviously the banks which have higher infra exposure and which have expertise in lending to infra would benefit more. And I guess you have a set of banks which are retail banks, and you have a set of banks which have exposure to corporate lending and infrastructure. So from this change, obviously the latter would benefit more.
Okay. What's the view itself on public sector banks? We saw some run up. You're speaking of a recovery, a fairly sharp recovery in the economy. Will you still, is there still space to buy them?
Yes, I think if the economy does well, definitely they will get a tailwind. But we are being selective now, largely concentrating on the larger PSU banks. Because if you see the tier 2, tier 3 PSU banks, in terms of operational performance, in terms of CASA, their business profile is not as good as the large ones. So we're tending to concentrate on the larger ones, but there's no denying that they'll obviously do well if the economy does well.
So would you extend that view to capital goods as well? I mean, we've seen a huge outperformance from something like L&T, but is it only L&T that you would be interested in, or are there, names like Crompton, etc., in the broader markets that look good?
No, definitely there are a lot of mid-caps and capital goods we are positive on. And again, I mean, it's natural that if the economy revives, they will also get a big tailwind in earnings. And while they've outperformed over the last 6 to 9 months, again, if you see on a 3 to 5 year basis, a lot of these stocks have not given very great stock appreciation. So you're not buying them very expensive on a normalized earnings basis.
Are you talking about L&T? I mean, that's
No.
not 70%. Or the broader markets, you mean?
The mid-caps.
The mid-caps. So that there is more scope to invest in mid-caps like Crompton, etc., rather than L&T at this stage.
Overall, we still think mid-caps is a better place to be than large caps because again, while there's been some valuation convergence in the last 6 months, on a 3 to 5 year basis, they're cheaper. And also, they have more leverage to the economy, both from an operational and from a financial viewpoint. So, like, for example, we definitely feel over 1 or 2 years, interest rates will trend down. And the interest cost as a percentage of EBITDA would typically be higher for mid-caps. So you get more financial leverage also, apart from the operating leverage.
Will you buy infra?
Selectively, yes.
Okay. Well, there is another query from our money control guys, and this one has actually been posted by a reader from UAE. Azim has posted a query from UAE. He wants to know if it's a good idea to bet on the metal space. Actually, they've done very well in the past few weeks.
Right. So obviously, China is always a big factor for metals, but again, we think there are some select metal stocks which also have exposure to the domestic economy. So as long as metal prices don't change a lot, some of these metal stocks can do well, also getting tailwind from the Indian economy. So we will definitely look at that space.
Finally, what about the NBFC space? It got a huge beating because of this debt mutual fund tax SOP getting removed. Is that a time to buy into that space?
Again, see, the structural viewpoint we've been having is banks are better than NBFCs because the liability franchise obviously is a key differentiator between NBFCs and banks. And to scale up in India using wholesale funding seems to be an issue because the bond markets are not very deep. So from a structural viewpoint, we've been preferring banks over NBFCs. But again, if we have some mid-cap NBFCs which have a very good niche in terms of either customer segment or product segment, we would definitely look at them.
All right, Manish, we leave it at that. Thank you for joining us and giving us your view. That's a rather optimistic view coming in from ICICI Prudential.